These three ETFs not only provide monthly dividend income, but solid dividend growth and dividend yields. And when combined together, they can provide great growth opportunities and diversification. And in this video, I'll be going over the strategies that make these ETFs stand out, the benefits of combining these three ETFs together, and if you should look into getting these three funds. So let's not waste any more time and get right to it. First, let's get into the strategy of how these ETFs choose their stocks. This first ETF is going to be QDVO, the Amplify CWP Growth and Income ETF. This fund's primary objective is to provide capital appreciation and secondarily generate high monthly income. So let's talk about QDVO's selection methodology. First, this ETF holds stocks from the Russell 1000 Growth Index and is primarily made up of large cap stocks with growth characteristics that provide dividend income and the opportunity for capital appreciation. Next is that sector allocation is managed and determined through a variety of factors by the portfolio managers. QDVO's portfolio is filtered down to 20 to 40 stocks that are screened based on earnings, cash flow, and other metrics. And it has a cap on individual stocks of 15% and a sector cap of 50%. Also, QDVO writes covered calls on individual stocks and sometimes indexes as well. And these call options are written on 30 to 50% of the total portfolio. This fund also seeks to generate income of about 4 to 6% from option premiums and 0 to 2% from the dividend income of its holdings. This next ETF is DIVO, the Amplify CWP Enhanced Dividend Income ETF. Now, this fund is an actively managed fund that's made up of large cap stocks along with the tactical covered call strategy on individual stocks. And there's a few parts to DIVO's selection strategy. First is that it holds high quality large cap companies from the S&P 500 index that have a history of increasing dividends and have strong fundamentals. Next is that DIVO is relatively balanced among the 10 S&P sectors, with CWP managing sector exposure to capture defensive and cyclical trends throughout different market cycles. And DIVO's portfolio is made up of 20 to 25 stocks, and there's a mix of growth and value stocks that are screened and adjusted based on market cap, management's track record, earnings, cash flow, and more. It also has a sector cap of 25%, and no individual stock can make up more than 8% of the portfolio. DIVO also uses a tactical covered call strategy by writing covered call options on individual stocks to generate additional income. And it does this by writing options on around 20 to 30% of the portfolio. Also, DIVO aims to provide income annually of about 2 to 4% from option premiums and around 2 to 3% from the dividend income of its holdings. The third ETF is IDVO, the Amplify CWP International Enhanced Dividend Income ETF. This fund invests in international large and mid-cap companies from the MSCI ACWI X US Index. And like the other two funds, it also uses a tactical covered call strategy on individual companies. Now let's talk about its selection methodology. First is that quality large cap companies are chosen from the index that they believe will sustain their cash flow growth, earnings, and increase dividends consistently over time. And the portfolio managers identify sectors or countries that are outperforming the market and increase the fund's exposure by choosing top-performing stocks within those groups. IDVO's portfolio is composed of 30 to 50 stocks that are screened based on earnings, cash flow, return on equity, and other metrics. And like DIVO, it has a sector cap of 25% and a stock cap of 8%. This fund uses a tactical covered call strategy on individual stocks to lower risk and enhance total return. And the fund writes call options on a range of 30 to 60% of the total portfolio. IDVO seeks to provide an annual income of around 2 to 4% from option premiums and 3 to 4% from the dividend income of its holdings. Now let's get into the portfolio differences of these three ETFs and how they can benefit from being combined together. Starting with QDVO, this fund contains 44 holdings in total. And its top holdings are in names like Nvidia, Apple, Microsoft, the other Mag 7 companies, Broadcom, Visa, and AMD, which make up about 60% or so of the total portfolio. For the sectors, it's primarily exposed to technology is nearly half, then communication, consumer discretionary, and the remainder in a few other sectors. You can see that this fund is heavily concentrated in the Mag 7 stocks, so it leans much more into the large cap growth stocks. Next up is DIVO. This ETF contains 27 holdings in total, and its top holdings are in companies like RTX, Caterpillar, Microsoft, CME Group, American Express, JP Morgan, and others, which combined make up about half of the total portfolio. Getting to the sectors, DIVO is mostly exposed to financials, then technology, consumer discretionary, industrials, and a handful of others. DIVO provides some nice diversification with a mix of quality blue chip companies, and those sector and stock caps that it has in place help prevent the fund from having too much concentration in one place. As for IDVO, this fund contains 65 holdings in total, with its top holdings in companies such as Alibaba, Taiwan Semiconductor, Novartis, Barclays, ASML, and others that make up around a third of the total portfolio. The sectors this fund is exposed to are financials, technology, materials, industrials, communication, and more. So it comes with quite a bit more holdings than the other funds and a more diverse spread of sector exposure as well. And if you look at the exposure to the top countries, it also offers a good level of geographical diversification. So now that we've gone over the portfolio makeup of these three funds, do they mix well together? Well, first, let's talk about portfolio overlap, which is the level of overlapping stocks or assets that the funds have between each other. The higher the overlap, then that means more concentration, which increases your risk, and that reduces the benefits that would come with more diversification. So when it comes to QDVO and DIVO, together, they have around 25% of overlap in weight, which comes from names like Microsoft, Apple, Meta, and Visa. For the combo of QDVO and IDVO, together, they have an overlap in weight of just about 4%, and that comes from money market funds and short-term investments like the Amplify SOFR ETF, which gives you exposure to repos or repurchase agreements, so no overlap in stocks. And the last combo is DIVO and IDVO, where there's about 5% of overlap in weight, and that's from the same money market and repo investments. And there's also a bit over 1% in Agnico Eagle Mines, which is a gold mining company. So overall, most of the overlap between all of these funds comes down to some Microsoft, Apple, Meta, along with some fixed income investments. The combination of these three ETFs gives you exposure to a variety of sectors, quality growth and value names, along with exposure to other countries through international stocks. And while these funds are a bit more concentrated due to the more limited amount of holdings that they have, the different strategies that each of these funds have in place allow them to work in unison for a nice portfolio mix. Also, keep in mind that having overlap isn't the end of the world, but it's something important that you need to be aware of, and to ensure that it falls in line with your investing strategy, your risk tolerance, and what you're comfortable with. Now let's talk about the dividend yield, income history, and dividend growth. For DIVO, when it comes to the dividends, it currently has a dividend yield of 4.6%, and the dividends are paid out every single month. As for the dividend growth, it's had a 5-year annual dividend growth rate of just over 12%, which is great to see. And now it has 3 consecutive years of dividend growth, which you can see while it can fluctuate some, overall it has gone up over time. Also, I want to point out, if you check the dividend income over the last 12 months, you'll see that in December, there was a huge spike in the dividend payment, and no, that's not a mistake. This large payout can be due to a combination of capital gains and partial or deferred income that they withheld from earlier months. Here's a screenshot from the prospectus, but these estimates are so they can provide a more even and consistent income to investors, since the real income fluctuates. And if the actual income is higher than the estimates, it could lead to a high end-of-year payout, since these gains are distributed annually. This is something to note in the prospectus for all 3 of these ETFs, so you can see this happen for some years and others you might not. Next, for IDVO, this ETF has a dividend yield of 5.3%, which it pays out monthly. For the dividend growth rate, since this fund is under 4 years old, I'll use the 3-year annual growth rate, which is 59% annually, but take this with a grain of salt. If we check the growth year over year, you'll see that it's so high because of the jump in total dividends from its first year, which was short, since it was created in September. Growth from 2023 to 24 was about 11%, and 2024 to 2025 is 13.5%. and it'd be great if it can maintain that range over the long term. And if you look at the payments over the last 12 months, you can see that they've been pretty nice and steady. As for QDVO, when it comes to the dividends, it currently has a dividend yield of 9.8%, which is paid monthly. As for the dividend growth, since it's been out for less than a year and a half now, we won't have any yearly history to go off of. But you can see here, 2025 closed out with $2.88 in annual dividends, and 2024 is so small because there was only 4 months of dividends since it was created. Looking at the last 12 months of payments, QDVO's income has increased over time, but it's obvious it fluctuates a bit more than the other two funds as it leans into more volatile and aggressive holdings. Overall, these funds have great dividend yields that are above the norm, and they can offer relatively consistent dividends, solid dividend growth rates, and on top of that, the income is going to be distributed monthly. Nothing comes free, so let's review the cost of these 3 ETFs. With DIVO first, this ETF comes with an expense ratio of 0.56%, costing you $56 per year for every $10,000 invested. Next is IDVO with an expense ratio of 0.66%, costing $66 per 10K invested. Then QDVO with an expense ratio of 0.55%, costing you $55 yearly for each $10,000. These fees might seem a little bit high, but remember, they're all actively managed funds that are selecting stocks and generating income for you. And for active funds, their fees are pretty fair. Next, we'll be covering the returns of each of these ETFs and how they performed against the overall market. Starting with DIVO, this ETF has had 5-year annual returns of a little under 13% and annual returns of about 12.5% over the past 9 years since it was created, which is definitely solid. For IDVO, this fund isn't that old, but it's had annual returns in the last year of a little over 38% and annual returns of 21% since it was created in September 2022, a little over 3 years ago. Those are great returns as international stocks have really been moving. That leaves us with QDVO, the newest of the group, and it's had returns over the last year of about 20%, and since it was created in August 2024, it's had total returns of nearly 34.5%, so another high flyer. So how does this stack up against the overall market, such as the S&P 500 index? Well, if we compare it against the S&P 500 ETF VOO, since QDVO was created in August 2024, so about 16 months ago, you can see that these 3 ETFs did very well. QDVO and IDVO well outperformed the market, and while DIVO did have the lowest returns, it just fell a little short of the S&P 500. If we scale out some more, since IDVO was created in September 2022, just over 3 years ago, we can see that IDVO has provided some strong returns in the few years that it's been around. And while DIVO didn't outperform the S&P 500, it still provided good returns. And you won't find QDVO here since it didn't exist yet. This comparison was just to give you an idea of how each of these funds have performed relative to the market, but this doesn't mean that each one is a substitute for the S&P 500 since they all have different approaches. While DIVO provides stability and a more defensive and value tilt, it's managed to offer good returns. QDVO with a strategy that gives you exposure to strong growth companies, which includes the Mag 7 names, it's no surprise that it managed to perform so well in such a short time period. And the third piece, IDVO, has done extremely well, not only thanks to the management team, but from the outperformance that we've been seeing from international stocks. Now that we've gone over the core points to these ETFs, let's talk about the pros and cons of this 3 ETF setup. Starting with the disadvantages, this first one is going to be the dependency on the management team. All these funds are actively managed, and the potential for losses falls into the hands of whether or not the managers can make solid selections or not. Next would be that all of these funds use covered call strategies. Covered calls are going to cap the upside potential as you're trading that potential capital appreciation for income. And while these funds write on a smaller portion of the portfolio so they can still offer some decent growth along with that income, in the end, you'd still be falling short in performance compared to if you were just holding the underlying stocks. All these ETFs also have some pretty concentrated portfolios. DIVO has about 27 holdings, QDVO 44, and IDVO is the largest with only 65 holdings in total. This falls back on the dependence on the portfolio managers, as a handful of badly chosen, underwhelming stocks could increase risk, volatility, and the opportunity for subpar results. As for the pros of this income ETF trifecta, the first is going to be diversification. I'd say one of the best benefits to this combo is that it gives you exposure to US stocks and international stocks, as well as it provides you with a blended mix of growth and value holdings across the board, providing balance across holdings, sectors, and countries. The next benefit would have to be dividends. While not all these funds are that old, so far they provided great yields, double-digit annual dividend growth rates, stable dividends with QDVO fluctuating more, and they pay monthly. These are all big pluses when it comes to looking for an income-generating fund. This next one is going to be growth potential. The returns for all these ETFs have been very solid, with IDVO and QDVO being the big standouts. In terms of the nature of its strategy, QDVO is going to be the primary fund that you'd expect to see great returns from, and so far it hasn't disappointed. With DIVO's strategy of providing a more stable and defensive base, I would expect it to shine more during rough markets. With IDVO, I can say the same, but international stocks have been on a tear, and that momentum might stay around for a bit longer. I could see the continuation of solid returns for IDVO in the near future if we see the shift out of the high beta and overvalued US stocks, the dollar weakening, and increased economic activity in these other countries. So, are these three ETFs worth investing in? I think these ETFs should really only be on your radar if you're past the accumulation phase of your investing journey, so you're not trying to optimize the growth of your nest egg anymore. If that's the case, then these funds could be an option to consider looking more into, as not only do they provide income on a monthly basis, but they still provide some level of growth potential thanks to their strategies. The combination of these funds give you exposure to equities across the globe, and if you have conviction in the management, then this could be a powerful trio. Now, these three ETFs don't need to be the only funds in a portfolio, as this could be a 3-fund setup that makes up the income portion of a portfolio, or maybe a portion that's geared towards income-generating ETFs. There's also many other great ETFs that could be mixed in with these funds. For example, someone could incorporate an index-based cover call fund like gpix or spyi as a base, and then add or combine it with one or more of these Amplify ETFs to boost diversification, or through a wide variety of other ETFs as well. And if you want to learn about more options for high-yielding monthly dividend ETFs, then be sure to watch this video here, or if you want to see how QDVO stacks up against the best monthly dividend ETFs on the market, then check out this video here. If you made it to the end, thank you so much for watching, and don't forget to hit that like button and subscribe for more content. Keep on investing, and I'll see you in the next one.